Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 10th day of September 2019. I do like to remind you each week that I am the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And we are having, notwithstanding a down day today, we are having a very good time in the junior exploration sector these days. I just got back from the Metals Investor Forum in Vancouver, where I learned of a number of new stories that I expect to be bringing to my subscribers in the near future, but in addition, of course, to the ones that we already have that are very exciting, not the least of which a couple of sponsors to this show, Great Bear Resources, Novo Resources, Klondike Gold, Radisson Mining, and there will be others coming along, I'm sure, in the near future, but a lot of great things to look at with gold. Well, it's dipped a little bit below 1,500 today, but I don't think that's going to last for long. We'll have to hear what some others on this show have to say a little later in the hour. So it's miningstocks.com to go to sign up for my newsletter, miningstocks.com. Also like to encourage you to check out Chen Lin's letter, What is Chen Buying, What is Chen Selling? And to sign up for that letter, you can go to chenpicks.com, chenpicks.com. Chen has done extraordinarily well with his investments over the years and is sharing his insights and his intelligence with his paid subscribers. And I do want to thank all of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel, and also encourage you to send along whatever comments you have about this show to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com. And we do want to thank our sponsors for making this show economically viable. I just mentioned who they are, but I will mention them once again. Klondike Gold, Novo Resources, Radisson Mining Resources, and Great Bear Resources. And by the way, I was just in Vancouver and interviewed Chris Taylor, the CEO of Great Bear Resources, one of the most spectacular new gold discoveries in recent years. And when that link is available, I will be sending it out to the list of people people that are on my list that hear about this radio show every week. So we're very pleased. I'm very pleased to have these companies as sponsors because they are doing very well, all four of them. I think Novo Resources, Quinton Henning will be with me next week to give us an update on the Egina project that is looking very exciting. The stock isn't really reflecting it these days, but if you watch what is really taking place on the ground, it's sort of the boring aspect of mining when the companies develop and outline a project, a deposit, then how do you get into production, producing it profitably? And that's where Novo is working on very hard right now on its one of 3 projects in Australia. That is the Egina project, and Quinton will tell us some more about that next week. I've titled today's show, Preparing for a World Run Amok. John Rubino and Michael Oliver are my guests this week. Michael will join me in the second segment of this week, and we'll have a bit more time than we normally have when he joins me during this segment. The title of today's show resulted from recent interviews that I've had a couple of weeks ago with Alistair McLeod and last week with David Stockman. Alistair provided what seems to me the most rational dynamic for causing the existing dollar-centric global trading architecture to collapse, or at least to be taken out of that status. And that dynamic is negative interest rates in the reserve currency, which is far more critical to the world's existing currency structure than if a lesser non-reserve currency like the yen or the euro experienced negative rates, which of course they are. Over much of the treasury curves of both of those countries, I think in fact in Germany the entire treasury curve is negative. Alistair pointed out that since all the commodities in the world are quoted in dollars, and because all commodities have a positive time preference value, if central banks actually take money away from you when you lend to it, there would be no reason at all to lend that money to this to buy treasuries, to lend it to the governments in buying treasuries. Rather, in order to protect yourself and your own interest, you would trash your dollars, which are costly to hold in that case, and exchange them for commodities that actually do provide positive carry, positive preference, time preference. In fact, as Alistair pointed out, gold normally has a time preference collectively across the markets of 1.5% to 2%. So, actually, we are looking now at This is why the bullion banks, according to Alistair, are why we are seeing the rise in gold prices, notwithstanding today's pullback a bit. It works something like this with the bullion banks. When the U.S. dollar interest rates are above gold's one-year lease rate of about 1.5% to 2%, the bullion banks were borrowing gold from central banks, selling it into the markets, driving the price of gold down, of course, and using the proceeds to buy U.S. treasuries at, say, 4% or higher. Now, if those same banks add some leverage into that equation, they can make huge profits, and indeed that's what they've been doing over the years. It seemed like a very good trade as long as U.S. interest rates remained above the positive, that is the interest rates for gold. But now, with the U.S. dollar rates below the lease rate for gold, that gold carry trade is no longer profitable for these bullion banks. In fact, it's actually beginning to cost them money. And if U.S. interest rates continue to head towards zero and then into negative territory, the gold carry trade will cost the bullion banks tons of money, probably hundreds of billions of dollars if they don't unwind in time. Of course, there is no doubt a huge fight is taking place among central bankers behind the scenes. We just recently heard William Dudley, formerly of the New York Fed, suggest that Chairman Powell should do all that he can to make sure Donald Trump is not reelected, noting that the trade war with China is forcing the Fed to lower rates. Perhaps Dudley perceives the same dynamics that Alistair McLeod noted, although I'm not sure that's the case, but neither is Alistair actually. But perhaps Dudley realizes that in any event, the dollar's reserve status is in trouble if U.S. interest rates continue to head lower for one reason or another. As people around the world seek positive yields to carry with their time preference values, money is flowing into the United States. And that is the dynamic that suggests that the interest rates in the U.S. are inevitably heading lower. We're seeing across the yield curve, for example, in Denmark, Germany, Netherlands, and in Finland, those four countries, across the entire yield curve, their treasuries are in negative territory. And for most of the rest of Europe, and Japan, Austria, we're looking at Ireland, Spain, those countries all have negative yields at least through the 10-year period. And so most of the world is experiencing negative yields. Now, what's happening is that we are seeing a lot of people, a lot of, pension funds and just plain people that need positive yield are borrowing or actually lending money into the United States to buy not only U.S. Treasuries, but also investment-grade bonds. In fact, something like 94% of the investment-grade bonds in the world are denominated now in U.S. dollars. As foreign money seeks positive yield, it drives interest rates lower and lower here in the United States as well. So with central banks around the world having destroyed the capital markets with massive money created out of thin air over decades now, it seems that the U.S. is destined, it would seem, for negative rates to occur here as well. And even Alan Greenspan said so on September 4th on CNBC. He opined that it's just a matter of time before the U.S. rates go negative as well. Well, I don't believe Alan Greenspan has predicted that the dollar's days are numbered. The dollar's days as the world's reserve currency are numbered as a result of that. But another central banker has, and I'm talking about Mark Carney of the Bank of England. He calls for a global monetary system to replace the dollar. He said so just a few weeks back at Jackson Hole, Wyoming. And if we go back and look as far back as 1988, The Economist put out a special article suggesting that by 2018, the existing dollar, or actually they said a petro-yuan futures markets may very well. Well, actually, the Economist said that they expect that we will see a new currency by the year 2018. I'm suggesting that some of the things that are evolving right now, such as the opening of the petro-yuan futures markets and the gold trading, international gold trading out of China, and the buildup of tremendous amounts of gold in China and Russia and other countries that are basically want to see the dollar's demise, is something that we should be keeping an eye on. And so we have now, again, top-level central bankers suggesting that the dollar's days are numbered as the world's reserve currency. And this is, anybody that studied history shouldn't be terribly surprised by this, because if we go back and look, actually the United States has had the world's reserve currency as long as some other world powers in the past. It's longer than the Netherlands, longer than Portugal, for example. Some countries like Spain, France, and Britain have held on to reserve currency status a bit longer than the United States. But there's no doubt about it that the dollar's days as the world's reserve currency would seem to be, it's not going to last forever. And there certainly seems to be some handwriting on the wall that would suggest its days may be over sooner rather than later. I think a quote at the end of an article written by Alistair MacLeod on August 29th that really suggests the end of dollar hegemony. And let me just quote, this is the end of an article that Alistair wrote titled Negative Interest Rates and Gold, as I say, dated August 29th, 2019. He said, and I quote, "Instead of central banks stabilizing the system of monetary easing, or stabilized by monetary easing, the easing itself will generate the crisis. The development of a problem in gold markets, driving gold price rapidly higher while some banks are caught napping, is likely to anticipate a wider financial and systemic crisis. Therefore, with gold's sudden move higher, coupled with its persistent strength, we can be reasonably certain that we are seeing the start of the dismantling of the dollar-based monetary system, and that gold has much further to go." End of quote.